You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, my co-host John McEwen. In this week's episode, we'll be discussing Cineworld, Kingfisher, Fevertree, Gama Communications, Unite Group, and Upwork. And there'll also be a book review of The Ascent of Money by Niall Ferguson at the end. So, John, shall we start with what I assume will be the worst?
Oh, it's not good. So, Cineworld, the world's second largest cinema chain with 767 cinemas, reported their full year results, announcing an operating loss of $2.2 billion in 2020. And that compares with a $724 million profit in 2019. And they've been impacted by asset impairments of over 1.3 billion after being temporarily closed from mid-March with a delay of many major box office releases in 2020. And they were last open in October 2020. And this is in Europe and in the States. Their main markets are the US, followed by the UK. The group's adjusted EBITDA was a loss of $115 million, and that compares with a profit of $1.5 billion in 2019. And revenue came in at $852 million, down from $4.3 billion in 2019. Admissions and box office revenue decreased by 83 and 84.9% respectively in the US, and in the UK it was down 76.3%, and box office revenue decreased by 75.5%. And also the average ticket price in the States decreased by 11.2% to $9.31 compared with $10.50 in 2019. The decrease reflects the lack of premium film releases available across the premium offerings. And they also stated in the report that there would be a binding commitment from a group of institutional investors for a new $213 million convertible bond due in 2025. And they temporarily suspended the company's borrowing limit. Net debt currently stands at about $8.3 billion. And unsurprisingly, the dividends remain suspended. The plan is to open US cinemas on the 2nd of April and in May back in the UK. And for reference, while being a UK listed company, the majority of the revenues come from the US. So back in 2019, it was $3.2 billion in the US compared with $648 million in the UK. And then the rest of Europe was an even smaller amount still. The chair said, "The group has demonstrated a resilience through what has been a very difficult year, and I am extremely proud of the commitment our colleagues have shown during these exceptional times. Despite the significant challenges that COVID-19 continues to present, we look forward to reopening cinemas worldwide and welcoming our guests." So they were very, very grim results, and it's not clear that their guests are going to return. What do you think of these results and the prospects of Cineworld, Sam?
I think the results are probably as we expected. The result, I guess, sounds worse than it is because that loss is so big because of the impairment, which is why when it's adjusted, it's only whatever it was, $115 million. Still not great. And then, what did you say, $8.4 billion of net debt? And that's for a company with a market cap of 1.41 billion pounds. Maybe it survives, but the biggest risk to this company, I think, is the reopening, because it's not going to reopen at anywhere near 100% capacity. I don't think, even with like pent up demand or anything. I think it's really bad.
And I'm not sure when the bigger films are going to come through. Certainly James Bond, I mean, that's been delayed multiple times. I think it's supposed to be this autumn now, but who knows? And also some of the big films are going straight to streaming services, or they're doing, streaming services and cinema, but, will people go back to the cinema, and certainly will they pay the prices as well?
Even if a small proportion don't, I mean, whenever I went to the cinema anyway, you'd look around and it never seemed like there were that many people there. And if say another 20% of those people are going to watch it at home and pay like however many dollars on Disney Plus to watch whatever the newest film is, it was already in my view, an industry that was struggling, and then it's been hit by a pandemic, and then it seems like the world's changed afterwards in ways which makes it even worse. I don't know why you'd want to invest in it as much as I like the products.
Yeah. No, I would tend to agree with you there. I certainly wouldn't be risking anything investing in Cineworld at the moment, or probably going forward, but could be wrong.
All right, should we move on to?
I don't think there's much more to add to that.
Probably not going to be the pick of the week then.
It's we won't spoil it. I think we do have some better companies coming up. So what's next?
We've got Kingfisher next. So for anyone who doesn't know Kingfisher, they are the owner of B&Q, Screwfix, TradePoint, and then some European subsidies as well. So they have released their full year results. Oh God, I'm reading the wrong results, John. I'm reading Gamma.
Which? Oh, yeah, I was going to say, Sam. I was going to say, these sound like fantastic results of B&Q.
In fairness, they were good results. Right, we're gonna.
Yeah, but they were sounded like incredible results. I was thinking, why am I not in B&Q? I was like, bloody hell. No, I was getting quite excited about it.
I might keep the blueprint just so people know what I've done.
I was like, bloody hell, that's B&Q are smashing it.
We're gonna go for it this time. Right, so
okay,
it's gonna be a bit underwhelming now.
Yeah, that's right. I was honestly, I couldn't believe it.
So they've announced sales growth of 7.2% to 12.343 billion. Gross profit up 7.5% to 4.573 billion. Gross profit margins pretty much flat at about 37%. Operating profits up 223.7% to 916 million, and statutory pre-tax profit is up 634% to 756 million. Basic earnings per share is up from 0.4p a share to 28.1p a share. And the total dividends up from 3.33p a share to 8.25p a share. However, those comparative figures are so excellent and in hundreds of percents because last year there was a significant impairment of the Russian subsidiary, and that means that the non-adjusted results were not very good at all. So comparing to those is pretty unfair. So there was also a small impairment this year. And if you remove that and you remove last year's much larger impairment, you actually get pre-tax profit increase of 44.4%. Post-tax profit increase of 51%, and earnings per share growth of just 50.3%. And free cash flow grew by 391% to 938 million, and net debt shrunk from 2.5 billion to 1.4 billion. Companies highlighted like-for-like sales are up 7.1% with growth across all banners in the UK and Ireland, France, Poland, Romania, Portugal. Like-for-like sales were up 15.5% in Q4 of 2020 with growth across all retail banners and categories. E-commerce sales were up 158% and now represent 18% of the group's total sales. That compares to 8% of total sales last year. Click and collect sales were up 226% and represent 78% of the group's e-commerce sales compared to 62% last year. Retail profit is up 27.4% in constant currency, and they've said that's largely driven by the B&Q performance. Adjusted pre-tax profit up 44.4%, and that includes £85 million of non-recurring net cost savings. I do think it's worth adding because companies are very, very keen to adjust when they're taking something bad out. But if these cost savings are non-recurring, then I do have to question why they weren't removed in the adjusted results. It seems a bit one-sided that they're adjusting the one-off impairments out and then not the one-off non-recurring cost savings. But anyway, free cash flow of 938 million, which was up by 747 million, reflected higher operating profit and working capital inflow of 376 million, as well as lower capital expenditure. In terms of the outlook for the 21-22 financial year, they've announced a good start to the financial year with strong demand in the UK and France. They said Q1 like-for-like sales were up 24.2%, which they've interestingly only measured up to 18 March 21. I know that's only when the results came out. However, that is literally up to the point where the lockdown kicked in. So you'd expect them to be good. in the first half of 21-22, they expect low double-digit like-for-like sales growth. And in the second half, they're planning for like-for-like scenarios ranging from -15% to -5%. And they've said the second half is likely to be impacted by strong year-on-year comparables and uncertainty over the macroeconomic and consumer environment. There were a few points from the slides I wanted to talk about. So they've highlighted that their industry actually provides relatively high margins compared to other retail industries. They've said that they're resilient against e-commerce pure play competitors, and they believe they've proven to be robust through economic downturns. They've also highlighted that COVID has established new longer term industry support in the form of more working from home, a new generation of DIYers emerging, and a desire for increased comfort and wellness in the home because people are now spending more time there. They've highlighted that they have at least a top 2 position in all their key markets. And those markets are France, the UK and Ireland, Poland, Romania, Russia, which they've now exited, and Iberia. And that includes number 1 positions in the UK, Poland and Turkey. They've said there's collective buying scale and successful own exclusive brands, and their own brands represent 44% of total sales, which possibly helps explain why the margins are so good. They've highlighted strong e-commerce sales growth and penetration of 18%. And they believe that their e-commerce progress has been accelerated by at least 2 years as a result of COVID. In terms of their geographic summary, so we've got total sales excluding Russia of 12.154 billion. And that's made up of 5.7 billion in the UK and Ireland, 4.3 billion in France, 1.5 billion in Poland, 310 million in Iberia, and 242 million in Romania. In terms of valuation, companies trading at a market cap of 6.81 billion and a price to earnings ratio of 11.32. I actually liked the business. My only real complaint was I just felt like there may be better opportunities out there, but it seems like a good business at a reasonable valuation to me. What are your thoughts, John?
Yeah, very reasonable valuation. I mean, can you think of another physical retailer that would be performing as well as this at such a reasonable price?
I'm trying to think. I'm sure the only one I can think of is maybe Halfords, but I don't remember being as impressed by Halfords as I was by this.
Yeah, and I suppose that an interesting point that you mentioned is how much would they be threatened by e-commerce? Do they have sort of a bigger moat against it in that they're DIY, and a lot of these sorts of things, whether it's showers, bathrooms, kitchens, you possibly want to see physically? Do you think that has something to do with it?
I think so. I mean, especially for like a tradesman or something. I mean, I'm probably the most limited kind of DIY there is. But like, I mean, if one of the bulbs go and I need to go and get a new one, I go to B&Q and I take the old bulb with me, so I make sure I buy the right one. And you can't really do that online. I know you should be competent enough to order the right kind of bulb, but I'm not. So I need to go in with the bulb, and that's certainly something where I'll always be going in store for that.
There is this business about DIYers and whether that sort of trend continues. I'm not sure with B&Q or with Kingfisher what proportion of their customers are trade and what proportion are your home DIYers.
No, I can't see anything. I can't find anything.
Impressive margins too.
Yeah.
I've certainly bought a lot of B&Q own brands. Probably regretted some of it, but I've definitely
37% gross margin.
Yeah, exactly. Very good. Yeah. So, and it's like we said, very attractively priced at the moment. But
Going for the watch
we can talk
list.
about that later. Possibly. It's not the most exciting business, but
it's not the most expensive either.
It's not. Yes, that's right. But next we do have, potentially a more exciting business, certainly a more expensive business, which is Fevertree. So for anyone who doesn't know, we talked about it on the podcast before, but it's the premium soft drinks, but really it's the tonic maker. That's what it's known for. So with their full year results 2020, the UK sales fell 22% to £103 million on the back of a 65% decline in sales from bars and restaurants, which account for approximately 45% of group sales and have the highest margins. Underlying cash profits were down 26% to £57 million, But fortunately, the retail sales grew 20%, which partly offset this. But overall margins fell from 29.6% to 22.6%. And currently, they have about 40% of the UK mixers market. Operating costs rose 8.7% to 59.3 million, with continued investment in marketing, particularly in the US. And from these results, it's the US sales that stand out. They grew 23% to £58.5 million, or 26% excluding the impact of exchange rates. And full year retail sales in the US were up 57%, and that was better than the management had been expecting. And they had a new deal with West Coast, which is a bottling partner, which should help ramp up the production in the US and reduce the sort of logistical costs of transporting the tonic. Meanwhile, the European revenues were up 1% to £65 million, with the core markets being Belgium and Denmark. And sales in the rest of the world grew 58% to £25 million, with particularly strong growth in Australia and Canada. Free cash flow was at 35.5 million compared with 65.4 million 2019, I should say. And that's largely because of the lower profits. The net cash had increased 12% over the year to 143.1 million. And the forward price to earnings is currently just over 50. Their market cap is 2.68 billion. And interestingly, from a historical point of view, since the company floated on the alternative investment market back in 2014, the average forward 12-month PE has been 47. So historically, it's not all that expensive, but it's not a cheap company. What are your thoughts on it as a company and at this valuation, Sam?
So I actually thought they were good results. There were a few things in the slides I wanted to talk about. So I thought it was interesting that they highlighted the launch of their sparkling pink grapefruit in the year in the US, which they say is tailored to tequila and spritz occasions. They talked about spirits are currently taking share from beer and wine. So in terms of global volumes, 2014 to 2019, beer has declined by 0.4% a year, wine has increased by 0.2% a year, and spirits have increased by 1% a year. And that's forecast to continue at least until 2024.
Because we saw that really when we had Diageo on, was it a couple of months ago? And it was pretty much, it seemed to be that picture with, and I think it was, you saw the Guinness sales going right down. And then I think tequila was doing particularly well. So yeah, it's a similar story, but from the other side of the coin, really.
And they highlighted as well that premium spirits are growing the most strongly. So the premium spirits, their market share of the spirits volume in the UK from 2010 to 2019 has increased from 9 to 17%, 19 to 27% in the US, 3 to 5% in Germany, and 19 to 34% in Australia. And I think that does bode well for Fevertree, because if you're getting a premium spirit, you're probably going to choose the premium mixer. And Fevertree they certainly think that they're the global premium mixer of choice. They've highlighted that in the UK, 70% of premium alcohol brands have grown retail category share during COVID. Yeah, their gross profit margin is 46.2%, which is quite high, really. What they're doing.
It's very high. Do you think it's sustainable?
If it's a premium product, then yeah, I think it is. As long as they can keep that premium image without it impacting growth, I think yeah. It's only if they try and go down market, I'd see it being a problem. So they've highlighted as well the mix change in the sales. So in 2019, the UK on-trade made 26% of sales, and that dropped to 11% in 2020. So that'll have been the closure of bars and restaurants. UK off-trade was 25% of sales. That's now increased to 31%. US was 18%. That's increased to 24%. Europe has actually dropped slightly from 25 to 24%, and the rest of the world is up from 6 to 10%. They've guided for strong growth as well. So they've guided for 6 to 9% growth in the UK, 18 to 21% in the US, 16 to 20% in Europe, and 16 to 24% in the rest of the world. And they've also highlighted that on the e-commerce side, they've launched a direct business with Amazon and created a branded page on Morrison's and Ocado's website. And they said that the percentage of their online sales coming from Morrison's has increased from 2.8% in the 12 weeks to 22 March 2020 to 12.2% in the 12 weeks to 27 December 2020. They also highlighted that the US premium spirits market is 11 and a half times bigger than the UK's. And they see runway for them to grow at least 5 times, which brings us on to the valuation.
Yeah.
I think if they can, I mean, at a PE of what did you say, just over 50?
Yeah. If
they can crack the US, I think it's justified.
Yeah.
And I think that PE soon comes down, but there's no guarantee they will crack the US is the problem. And I think, for 50 or 60 times earnings, for me, it wouldn't be on the hopes of they've done very well in the UK. It's going well so far in the US, but it's a big ask, really. And I just think if you're buying a company at 50 or 60 times earnings, you could probably buy a better one. That's not really meant to discredit Fevertree, because these are very good results. Given the year that they've had and the closure of bars and restaurants, I think really the main thing was basically to grow the non-UK sales. That was really, and they have absolutely nailed that, but I don't know. I think it's too risky to pay.
There was a bit of a sell-off. I think the shares were down about 8% on these results.
I don't know why. I mean, there can't have been much in there that was a surprise. I mean, if I was a shareholder, valuation aside, I'd be pleasantly pleased with those results. What about you?
No, I probably would be as well. And I suppose it's not priced for growing that much more in the UK. It is based on the expectations for the US. So yeah, I don't know whether I would be comfortable paying that much, but that's maybe me just being a little bit more risk averse to it. But it's certainly a company that I really like.
Yeah. No,
I've probably grown to like it more actually as well.
Yeah, these are good results, and I understand why it commands a premium. But for me, it's the same as you. That premium for me, I'd be uncomfortable paying that.
But I suppose you don't. In the UK, there aren't that many growth companies, and Fevertree has been one of the bigger ones over the last few years.
It has, and they have delivered so far. But I think it's one thing to deliver in the UK, but to then take it to the US, I think it's that UK track record. I don't think it's not a guarantee, is it?
No. I was going to say, do you mean for Fevertree or for UK companies generally trying to make it in the US?
I'd say it varies from company to company, but with something where you're taking a product that's not really known to then go and build yourself up as a premium brand, I think it's very, very difficult. That's not to say they can't do it, but I guess it's not the same as, say, exporting like a website that's maybe already quite well known or something. Not that we have any of those anyway, but at least it may be a bit easier.
Yeah, no, that's fine. But no, good results anyway.
Yes.
And it'll be an interesting one to watch in the next few years to see whether it can really crack America.
Yeah. So should we move on to Gamma Communications?
Yes. So Sam, you're going to have to do a bit of explaining here.
Okay. So Gamma Communications is a UK telecoms provider that sells a wide range of voice and data services, both fixed and mobile, to the business market. Unlike most telecom stocks exposed to a secularly declining industry, Gamma has focused on exploiting growth niches. As a leading player in areas such as SIP trunk deployment, which is, in simple terms, SIP trunking is the method used by many organizations to allow a business phone system to work over an internet connection, as opposed to legacy systems and traditional landlines. And they're also a leading player in hosted PBX provision. And hosted PBX is a private phone system within a business that enables users to make, receive, and manage calls easily and affordably. So an on-premise PBX is the alternative to a hosted one, and that requires an on-site installation of the hardware usually set up in a computer room. It requires the purchase of hardware, including a server to connect the telephone company with the IP phones. However, with the hosted solution that Gamma offer, The provider maintains and handles the technology for you, so setup and maintenance is included in the package. There's no initial investment as it's based on an OPEX model, and you're charged a flat monthly fee, including a bundle of minutes and features, plus an extra communication fee. As the phone's plugged into the router, it's completely operated online. So it sounds worse than it is. It's basically a telecoms provider that allows businesses to operate the communications over the internet. So they are, and this is from Aberdeen Standard Investments. They are an asset-light operator owning core network assets, but also leveraging third-party infrastructure where required. And they've built a strong position as a key provider to an indirect channel of business telecoms resellers, system integrators, and other telecom service providers. On their own About page, they've said that since their creation in 2001, they've rapidly become one of the dominant players in the UK communications market and increasingly on mainland Europe. In the UK, these businesses are cloud communications and contact center technology specialists, Mission Labs, Unified Comms, and MS Teams voice partner, Exactive, and UCaaS specialist, Telsys. And UCaaS is Unified Communications as a Service. In Europe, Gamma owns telecoms group Deen1 in the Netherlands, which in turn owns Nimsys, an ICT specialist for workplaces and multi-tenancy buildings, as well as Schiphol Connect, the telecom and internet provider at Schiphol Airport. Additionally, GNTEL is a telecom operator and supplier of complete hosted VoIP solutions to SMEs in Benelux and Germany, selling exclusively through its network of 300 plus partners. Gamma also has a controlling stake in Spain-based cloud PBX provider Voz Telecom, which, like Gamma, provides services to end users directly through a network of wholesale partners, franchisees, and dealers, and has an excellent reputation for delivery. In Germany, Gamma has acquired HFO, one of the leading SIP trunk and emerging cloud PBX providers that has an excellent reputation for product quality and service. HFO operates nationwide in Germany through a reseller network of over 1,000 partners. Through its Epsilon brand, HFO is also a large B2B mobile distributor in Germany, offering mobile communications from all three major mobile network operators. Moving forward, Gamma has a desire to expand its unified communications as a service presence in Europe, continuing to grow their family of businesses with a focus on digital automation, while maintaining their important relationship with their channel partners who deliver Gamma-powered services to thousands of SME customers each year. So they have released their full year results, and revenue has grown 20%, 393.8 million. Gross profit has grown 21% to 200.8 million. The gross margin is flat at 51%. Profit from operations has grown 66% to 75.7 million. Profit before tax has grown 66% to 75 million. Adjusted profit before tax is only up 28% to 61.7 million, and that's been adjusted to remove the profit on the disposal of a subsidiary. Earnings per share is up 84% to 66.6p, and adjusted earnings per share is up 26% to 51.3p. The total dividends increased by 11% to 11.7p. Cash generated by operations is up 30% to 70.3 million. In the highlights, the group said they've had a good financial performance across all business units with growth across all key product categories during the year. COVID-19 only had a small impact on the overall financial performance of the business, with cancellations, bad debt and churn continuing in line with their normal low pre-COVID-19 levels. They've highlighted that organic revenue growth in the period was only 9%, so that they've been acquiring European subsidiaries, which has helped boost the growth. They said organic growth was slightly lower than originally expected due to the lower rate of sales in the second quarter driven by the pandemic. Sales activity returned to pre-COVID levels in the second half. Recurring revenue in the year grew from 306.9 million to 359.3 million in 2020. And that's 359.3 million of recurring revenue out of a total of 393.8 million of total revenue. The UK indirect business continued to grow strongly with a focus on the existing partner base. And the UK indirect business, that division sells Gamma's products and services to channel partners, and that contributed 63% of the group's external revenue. And that compares to the direct business, which sells Gamma's products and services to end users in the mid-market. So the indirect service grew strongly with a focus on the existing partner base, gross profit increased 11% from 119.1 million to 132.2 million. The direct business continued to grow gross profit, which increased by 21% from 38.2 million to 46.3 million. The European business saw gross profit increase from 9.2 million in 2019 to 22.3 million in 2020, primarily through acquisition. Voz Telecom was acquired in April 2020, HFO was acquired in July 2020, and GNTEL was acquired in July 2020. In the product highlights, the group highlighted the number of installed SIP trunks increased by 17% to 1.185 million. And these figures include sales of the MS Teams direct routing product and seats on Exactive's Cloud UCX platform. The number of Horizon Cloud PBX users increased to 601,000, which was up 15%. And the number of Horizon users taking the additional collaborative service increased from 9,000 to 46,000. The number of hosted PBX seats in our European business increased to 114,000 at 31 December 2020, up from 22,000 on 31 December 2019. Much of this growth was via the acquisitions of Voz and GNTEL. Horizon Contact, their cloud contact center solution, which is a central point in enterprise hosted on an internet server from which all inbound and outbound communication, customer communications are handled. Yeah, so their solution, which resulted from the acquisition of Telsys in 2019, and is a fully integrated module for their cloud PBX product, was successfully launched in the UK on 2nd of March 2021. In the second quarter of 2021, they expect to launch their single line replacement product, PhoneLine Plus, and they will also release functionality which will enable Horizon users to integrate their cloud PBX with MS Teams. In the acquisition section, they've highlighted that they've continued to execute their strategy through selective acquisitions which both strengthen their unified communications as a service product functionality and expand their geographical footprint in Europe. And they talked about the 3 acquisitions which we mentioned earlier, which have expanded their presence in Europe. Acquisition activity has been high in 2020. We have bought 4 companies and the cash outflow for acquisitions in that period was 52.8 million. However, each acquisition was funded from internally generated cash flow. We believe it has been the most cost-effective way to build a footprint to take advantage of the future acceleration in unified communications as a service uptake in continental Europe. Subsequent to the end of 2020, we acquired Mission Labs Limited for initial consideration of 40.2 million, which was also funded from internally generated cash flow. Andrew Taylor, CEO, commented, "We've delivered a good business performance and set of financial results for 2020, with both our UK and European businesses continuing to develop and grow. We've begun to successfully knit together our desired European footprint and are working with local management to accelerate our growth in cloud PBX in Europe. Despite the COVID-19 pandemic, our product performance was positive. We continue to strengthen our market capabilities through the development and launch of new products and services. During the year, we've reinforced the execution of our unified communications as a service strategy, which is progressing very well. For the strengthening of both our geographical reach and overall product capabilities, as ever, we have continued to strengthen both our direct and indirect channel propositions across all markets, with a focus on positively supporting our partners and our customers." They also pointed out that in April 2020, that they launched a Microsoft Teams direct routing product to their channel partners, which made Gamma's market-leading SIP trunks available to enterprises using Microsoft Teams. This is an expanding market, and we've already connected thousands of individuals to the platform since launch. In terms of valuation, the company has a market cap of 1.63 billion, a dividend yield of 0.69%, and trades at a PE ratio of 32.76. My thoughts on the business are, I think it's very attractive. I think the growth is very good. I don't mind that it's been driven by acquisitions because those acquisitions are not diluting the shareholders. And also that it does look like they're being integrated well. I think it plays on the back of a lot of long-term trends. I like it. I like the results and I own it. John, your thoughts on Gamma Communications?
Well, I mean, it's certainly a company in a sort of an area of the market that I know nothing about. But I mean, the figures and the growth they produced is very impressive so far. I was wondering what competitors are out there for Gamma, because it has a very small market cap And certainly in the US, not that I know anything about this sort of industry, but I imagine Cisco and those sort of like really big players being in this sort of market. But I mean, I could be totally wrong.
I guess it's because they've adopted that strategy of finding their own profitable niches.
Mm-hmm.
But there's a website called Owler, and it actually lists their top competitors or alternatives. They've listed what they consider their 8 biggest competitors or closest competitors. The biggest one's a company called Adept. And that's actually a US company with revenues of 5.3 billion. Then after that, all of the other ones are smaller than Gamma, and they're smaller by quite some way. Only one of them's got revenue that's over 50% of Gamma's. The other companies you think about are the traditional telecoms providers, but I don't think they're really competitors either because Gamma's, it's going for those profitable niches. And so far it's been very successful at that. And I guess the strategy for it as well has been, rather than try and compete with the big boys and some of the other stuff that's not necessarily that profitable, they're just taking those niches and they're expanding them into Europe, and they're looking for other niches.
Well, no, it certainly sounds like an exciting business, and probably one that I'd look into further and try to understand it a bit better. But, you know, huge margins, and like you say, it's sort of picking out those niches. So it's,
What do you think of the valuation?
For the type of industry that it's in and the numbers that it's delivering, it doesn't sound that expensive. Certainly not as expensive as you'd expect it to be.
It's on the AIM, so I don't know if that has something to do with it, because it would be big enough to be FTSE 250.
Yeah, well, I mean, I suppose you've got, I don't know the exact ins and outs, but there's definitely less regulatory obligations for companies listed on AIM. And you've got some really big ones on there, like ASOS and Fevertree, I think, is still AIM listed. Boohoo too, I think.
Yeah.
So you got a few big boys.
Yeah.
On the minnow market, but it's genuinely one that I would potentially quite interested. Not put a large amount of money in it, but
that amount of growth for 32 times earnings.
It's not, And
I do really, really like the acquisition strategy where they're doing it through their own cash flow. It's quite refreshing to see it, and it's not diluted.
Yeah.
And especially these acquisitions, you can see it in the numbers. They're contributing very quickly to profit.
Yeah.
And it just feeds on itself.
Yeah. No, it sounds like a good business.
Shall we move on to
what have we got?
Unite Group.
So Unite Group, which is the UK's largest student accommodation provider, posted their full year results this week. And for 2020, earnings were down 12% from 110.6 million in 2019 to 97.3 million in 2020, which was in line with the board's expectations. And it's also reflecting the acquisition of Liberty Living, with the rent foregone for the summer term of 2019 to 2020 and reduced occupancy as a result of COVID-19, loss before tax of 120 million, and that compares with a 2019 loss of 101.2 million, driven by the valuation loss of 178.8 million, impairment of goodwill and intangibles. They've had 88% contracted occupancy and 1.1% growth in weekly rents for 2020 to 2021, 95% rent collection for the 2020 to 2021 academic year, and they're confident in retaining headroom under all their ICR covenants. They successfully completed integration of 24,000 bed Liberty Living acquisition. Target annual cost synergies increased from 15 million to 18 million for 2021, and they're anticipating strong student demand for 2021 to 2022, with reservations for 2021-22 at 66%, with later booking cycle expected due to COVID-19. 2019 to 2020 had been 77%, and they anticipate an occupancy of 95 to 98% and 2 to 3% rental growth for 21-22. And they quote a significant and growing development pipeline, secured development and university partnership pipeline of 599 million, which accounts for about 4,000 beds for delivery over the next 4 years, generating an attractive 6.4% yield on cost, opportunities to add to university partnerships and development pipeline at enhanced returns. They've also said that in terms of sustainability strategy, and doing what's right. They're targeting net zero carbon operations and construction from 2030, commitment to providing opportunities for all, backed by new diversity targets. And the chief executive has said, despite the challenges of COVID-19 pandemic, I'm proud that Unite has emerged from a tough year, showing our operational resilience and building on our commitment to doing the right thing to support students. The resilience and flexibility of our response under extremely difficult and changing circumstances has only underlined the quality of our teams and the value of our operating platform, Prism. Our response to COVID-19, we recognise that the past year has been a particularly challenging time for all students, which is why their well-being, safety and security has been our priority since the start of the COVID pandemic. All our properties have remained open and operational throughout the pandemic, recognising that for many students, our accommodation is their only home. Following the onset of COVID-19 pandemic in March, most universities chose to close their campuses, suspending all face-to-face teaching for the remainder of 2019 to 2020 academic year. In response, Unite was the first corporate PBSA provider to offer release of students from their tenancies for the summer term. We've subsequently offered students further rental discounts for 2020 to 2021 academic year, reflecting the challenges and disruption students have faced during the latest lockdowns. We've offered students significant flexibility to manage their changing circumstances, including the ability to extend their stay during summer 2020 at no further cost, and flexible or delayed check-ins for 2021-2022 academic year. They have stressed also that they've delivered on a resilient financial performance in 2020, with the EPRA earnings of 97.3 million, as mentioned earlier, and earnings per share of 25.5p, which is down 35% year on year. And that reflects the impact of rent rebates for the summer term of 2019 to 2020 and the lower occupancy in the 2020 to 2021 academic year, partially offset by cost savings made during the year. The loss before tax of 120.1 million, primarily driven by valuation loss resulting from income reductions linked to COVID-19. And they've delivered 15 million of cost savings from the Unite share, from insourcing of work over the summer, savings to utility and broadband costs, and a 4-month reduction in the remuneration for directors, cancelled bonuses. And in terms of going forward, they've commented that the government announced its plan for a phased return of students to university from 22nd of February 2021. From the 8th of March, universities are able to resume in-person teaching for students who are studying practical and practice-based subjects and require specialist equipment and facilities. And the government are also going to be reviewing the remaining students returning by the end of the Easter holiday. University campuses remain open. However, we anticipate that some universities will choose to switch to online-only teaching and assessment for the remainder of the year. Interestingly, they said that we know from their recent student survey that the majority of students want to return and enjoy university life. 86% of students are keen to get onto university campus once it's safe to do so. Meanwhile, 79% of students said that they want to receive some face-to-face teaching in the third term if restrictions are eased. And they've gone on to say as well, leading on from that the enduring appeal in the residential degree. And they see it rather than online teaching replacing the residential degree, universities see the potential for online learning to enhance the on-campus student experience. Learning will become more personalised through higher quality face-to-face interactions in smaller groups, tutorials and practical work, supported by online content made available for students to access at any time that suits them. And I mean, I think that interpretation, while it's been a bumpy year for Unite, is probably fair enough. I think most students, and the trend is for more people to go to university, and possibly as a result of spending so much time in lockdown with parents, I think people would probably, or students would be very keen to return to student halls and digs going forward. So I wouldn't have anticipated a longer term reduction in the trend of students going to university for residential courses and staying in Unite accommodation. I don't know what you think of that, Sam.
I generally agree. There were a few things in the slides that were quite interesting. So for 21-22, they're only 66% reserved, and that compares to 77% reserved this time last year. But they said weekly sales are up 150% since the government published their roadmap. So I think that does support what you said, where people, they don't want to be doing it at home. Yeah, their average yield is 5%, which is pretty high, really.
It's pretty decent
for property.
It's very decent. I'm not sure what to make of the Liberty Living acquisition.
It's hard to say, isn't it? Because the first year where it would have come through, the earnings have been smashed. Right? Yeah. So I actually think you'd need to give it another year to be able to judge it, to be honest. Interestingly as well, what did you think of the valuation? Market cap of 4.17 billion, PE ratio of 41, dividend yield of 1.22%. So that's based on earnings of 97.3 million. If you were to assume, and I think it's possibly quite a generous assumption, that 100 million pounds of rent that they decided to forego is added back in, you'd basically double those earnings, and that would bring it down to about 20.5. I still think, even if you make that very generous assumption that 100% of the foregone rent would go straight through to earnings, 20.5 seems like quite a lot to me.
For this type of business, I'd say so, yeah. But I think not cheap, but I think in the long term, it'll probably play out for it, but not something I'd probably be buying shares in at the moment, I don't think.
No. Should we move on to our final company then?
Yeah. So this is our US company.
Yes, it's Upwork. For anyone who doesn't know, Upwork's the outsourcing website, so you can use it to hire outsourcers from anywhere in the world for all kinds of jobs. They actually released their full year results about a month ago, but we were covering another company, and now that earnings season's really died down, I thought rather than cover a company that had reported this week that were potentially less interesting, we may as well just go back and do Upwork, especially since I'm a shareholder, so I do want to actually go through the results anyway. So,
and you have used it, you've used its services before as well?
I have, yeah. I've used it as a freelancer, so I've done it writing articles about. Sometimes I've done some stock analysis, and I've written a few articles about Bitcoin and cryptocurrency as well. Although I haven't done it. I probably stopped doing it about 18 months, 2 years ago. But there was a point where I was on it fairly regularly and doing quite well on it as well. I thought it was great. Even before that, actually, I used to use it as a teenager, and I used to get little jobs just writing about like the Premier League and stuff on blogs. So it is very good. So they have announced their fourth quarter and full year results. So they announced it a month ago. In the Q4 2020 results, they've announced that gross sales volume increased by 33% year over year to 727 million. Revenue increased by 32% year over year to 106 million. Marketplace revenue grew 34% year over year to 96.9 million. Marketplace take rate was 13.5%, up from 13.3% a year ago. Gross margin expanded by 2 percentage points year over year to 73%. Net income was 0.9 million, which compares to a net loss of 5.5 million a year ago. Adjusted EBITDA was 9.6 million compared to 3.5 million a year ago. And for the full year 2020, gross sales volume increased by 21% year over year to 2.5 billion. Revenue grew 24% to 373.6 million. Marketplace revenue grew 26% to 338.2 million. Marketplace take rate was 13.6%, up from 13.1% a year ago. Gross margin expanded 1 percentage point to 72%. Net loss was 22.6 million, and that compares to a net loss of 16.7 million a year ago. And the adjusted EBITDA was 14 million compared with 7.4 million a year ago. For 2021 year, they expect to report revenue in the range of 460 to 470 million. And adjusted EBITDA in the range of 12 to 16 million. So if we take their average of 465 million expected, that would give them an expected growth rate of 24.4%. And in the slides, we've highlighted that their client spend retention was 102%. So that means that on average, clients spent 102% of whatever they spent in the prior year. They said on the supply side, they believe that there's 225 million service jobs globally that can be performed remotely. And they believe and I'm not entirely sure how correct this is, but they believe that 50% of Gen Zs are freelancers. On the demand side, they've said 62% of people will be more remote than before COVID-19, and 47% of people are more likely to engage independent talent due to COVID-19. They've highlighted that in the normal way of hiring people, the average time to hire someone is 31 days, whereas with Upwork, it's 3 days. And normally when you're hiring someone, you're limited by geography or region, whereas with Upwork, you can hire someone to work remotely from over 180 different countries. So going back to that 225 million service jobs they believe can be performed remotely, the average freelancers' gross sales volume was $5,850 in 2020. So they believe that represents a 1.3 trillion global remote work opportunity. And they say that by 2024, remote workers will represent 30% of all employees worldwide. They've said in their marketplace, they've got over 50 different job categories, which have done over $10 million in gross sales volume, and 40% of their clients actually hired across multiple categories. They've got a net promoter score from both clients and freelancers of over 60, and their core client, by the way, is defined as a client that's spent in aggregate at least $5,000 since they began using the marketplace, and has also had spend activity during the 12 months preceding the date of measurement. So yeah, core clients, they said, was up to 145,400 in the year, and the core client year-over-year growth was 17%. Since 2015, when the core clients were 74,000, it grew 3% in 2016 to 77,000, 13% in 2017, 22% in 2018, 18% in 2019, and then 17% in 2020. And they said over 80% of the gross sales volume in their platform comes from the core clients, despite the core clients only representing 20% of the total client. So there's a bit of Pareto's principle in action for you. In terms of the valuation, the company's measured a market cap of 5.527 billion, and that gives it a price to sales ratio of 14. I thought they were good results. I like the business and I own it. I think the growth of the market as a whole, to me, it just seems very, very obvious. And I do see it as being something that's going to be absolutely huge in, say, 20 years' time. The biggest threat to Upwork is a company called Fiverr, which is another outsourcing website. And like I say, I've used Upwork before. I've used Fiverr, but I've only ever used it on the hiring side, which we actually use for our intro and our logo. And Fiverr is a threat, and they're growing at a faster rate than Upwork, but they're about a third of the size in terms of revenue, but they're growing at maybe 70% a year. I've always viewed Fiverr as more designy, which is why I use Fiverr for the logo and the intro. But I know they are trying to change that. But still, if I wanted to hire someone to actually work remotely full time, unless it was a design role, I'd probably still be going with Upwork. And they are still the market leader. And these are good results. And although the growth is slower compared to Fiverr, these are still impressive numbers, and it is from a larger base.
So do you think that's reflected in the price of Upwork compared with Fiverr?
Yeah, it is. So Upwork's a price to sales of about 14. Fiverr, it's more like 40. So Fiverr's, I think Fiverr's got the higher market cap. Yeah, Fiverr's got a market cap of 7.23 billion, despite the fact its sales are about half of Upwork's, but they are growing quicker. But I do think that it's going to be a huge market, and there isn't any reason why they couldn't both do well. There's a structural,
yeah, exactly. And there's a structural trend towards the remote working and outsourcing. So it's been, a winner from lockdown, but probably also that's maybe accelerated some of the changes that were already happening. But I suppose I like it as a company. I don't know how much I'd be willing to pay for it. And
14 times sales for a company growing at 20% a year. If you when you think about how high, I guess, that potential market could be, I don't think it's there was a point it actually IPO'd. It only IPO'd a few years ago, and because Fiverr was really eating its lunch at first, and Fiverr has much higher growth, but Upwork's growth was actually quite sluggish, and they've turned it around in probably the past year or so. But it IPO'd at about 20, and it dropped to about, I bought it around the time of the IPO. It dropped to about 4 or something. So it was down like 80% at one point, but it dropped to about, I want to say a price to sales of about 3, something ridiculous. And I probably should have loaded up on it at that point, but I didn't. But now it's up. So it's at the point where it's now at $44 a share. So it's comfortably beat the market since IPO, and it's up about 10x since that low. But yeah, it's certainly been a bumpy ride. And that multiple has expanded. It's gone from a price to sales of 3 to 14 in that time period.
Yes. So. Exciting.
It is, yeah. Right, so of the 6 companies we've talked about today, Cineworld, Kingfisher, Fevertree, Gama Communications, Unite, and Upwork. If you had to buy one, which one would it be?
I'd caveat this by saying I'd want to do research it more, but Gama did catch my eye from the companies this week.
Did it?
And I think I'd have to go. Well, you thought Kingfisher?
I thought Kingfisher. I thought you'd say that.
I think that, well, they'd probably be my top 2. In terms of watching from the sidelines, I would be very excited to see how Fevertree fares in the US. But in terms of actually investing, I'd probably be, probably Gama or Kingfisher. But Gama would require quite a bit more research, I think.
Okay.
Fully understand the business.
I'd probably go with Gama as well. So it's been a bit hard for me this week because it's actually got two stocks I own in, but out of Gama and Upwork, I would be going with Gama. I did like Kingfisher as well.
And at current prices as well, to be.
Yeah, I think, I like Upwork, and I think that, if you've got a 20-year time horizon, I don't think you probably wouldn't. You're less likely to regret paying 14 times sales now if you think it could be as huge an industry as I think it could be. But I mean, Gamma at 32 times earnings with that growth. And I do really like the acquisition strategy when it's being funded through cash flow. I think that's very, very smart, and it's working well so far. And I think management are just doing a really good job with it. So yeah, Gamma would pip it probably based on valuation.
Yeah. And I mean, I suppose we can always comment on valuation, but some companies like Upwork, they're never going to be priced like a Kingfisher, are they?
You say that, but price to sales at 3, you could have had it at a year ago.
If we talk about earnings.
Well, it doesn't have any earnings. That's not fair.
Yeah. Well, but this is it, isn't it?
Yeah, but it depends, because if it's growing at 20 or 30% a year, as long as it gets to earnings eventually, if you're picking it up at a price to sales of 3, I mean, I think that's... Yeah. I mean, that was just far too cheap, really. But I didn't buy any at that price, so...
No, well, this is the thing. If you're always watching from the sidelines and making these sort of comments, you're never invested. So
the thing is, it might have been at a price of sales of 3 or 4, but I was down 75, 80% at that point, so I didn't really feel like adding to it.
That's right. The conviction wasn't that strong. Well, it was strong enough to hold on, but not to.
I should have backed up the truck. I should have gone all in. Anyway,
fine. So
should we go?
You've read a book this week, Sam.
I've read a book. The book is The Ascent of Money: A Financial History of the World by Niall Ferguson, who we do like. So it is what it says on the tin. It's a financial history of the world. It's split into. It's one thing that quite annoys me about Niall Ferguson, actually. I really, really like his writing, but he'll do like 6 chapters or something. And when I start a chapter, I like to finish it. And that means that you get these really quite long chapters. It just makes it a bit more annoying to read. But anyway, it's 6 chapters. The first chapter is on the history of like actual money and currency. The second chapter is basically the history of the bond market and bonds. Third chapter is history of stocks. Fourth chapter is history of insurance. Fifth chapter is history of housing and our attitudes towards that as an asset, and also how it's developed, really, because obviously most people didn't have housing when we were in more of like a feudal system. So it's how that's evolved. And then the 6th chapter was really just an analysis of, the current world and how we got to the current state, where you've almost gone from this situation where, in terms of money terms, America's just this juggernaut, and now you're in a situation where it's got the deficit problems, and a lot of that deficit is essentially being financed by China. I mean, this was actually written in 2009, so I suppose the situation has evolved a bit now, where instead of the US deficit being financed by selling government bonds to the Chinese, instead they're just selling them to themselves and just printing all the money. But it's very interesting. I think if you are a beginner, it probably is quite a good read, because it covers pretty much every asset class, and it is well written. And I do enjoy Niall Ferguson's writing. So yeah, I would recommend that if anyone's interested in that sort of thing.
Yeah, it certainly sounds good.
We've also got a listener question. So it's Imagine Invest again. He said, how do you look at your portfolio allocation, specifically thinking about SIPs, pensions, stocks and shares, ISAs, GIAs? That must be general investment
accounts, yeah.
Do you look at them in the round? How do you ensure you don't double count? E.g. company pension investing in similar style to personal ISA.
Who do you want to start, or shall I start?
I think you started last time, so
okay, go for it.
Yeah, so I do think of them really as one portfolio. Well, I do and I don't. So I do think about the whole picture when I'm investing across different things. I have my pension set to invest just into globally diversified index funds. So I think it's about 20% UK tracker, 20% developed Europe excluding UK, 20% emerging markets, 20% North America, and Pacific Asia excluding Japan. Because of that, I take the view that with my LISA and my ISA, I can just do that in individual equities, and if I'm not as clever as I hope to be, then I've still got the pensions to fall back on the basis that that's hopefully going to do about 7% a year compounded until I retire. I then am pretty much entirely individual equities in my ISA and my LISA. However, it is split so that my LISA is entirely UK and my ISA is then US. So I've almost got two separate portfolios in there, but I do think about the whole portfolio. And then I've also got a pretty significant Bitcoin allocation now as well. But yeah, I'd always view the whole picture when you're doing it, but that doesn't mean there's no reason why you can't have crossover between them. What about you, John?
So certainly in terms of the pension, so I've got a defined benefit scheme. So it takes one worry out in terms of there's a fairly secure income that will be coming later in life. In terms of the rest of the strategy, I'm certainly very much indexing, and I use the biggest single holding. I've got some S&P 500, but most of it is in the FTSE All World index. So it's sort of, I think it's probably about 55%, something like that would be US. If you look at the UK as part of that, it's maybe 4 to 5%. And then it basically allocates globally on the basis of market cap. So you probably find that if you look at some of those big, US tech, Apple, Microsoft, they may be sort of 1% of the portfolio, but very diversified at a low cost through Vanguard. And I think if you were doing an indexing strategy, you could have the overlap. It could be the same, in your pension as it would be in your general investment account, as it would be in your ISA, your LISA, whatever else. I don't think that's necessarily wrong. I suppose if you wanted to have a bit of a play around with buying individual equities, then if you had an indexing strategy, which let's say was for your pension or for your lifetime ISA, then it might allow you to feel a bit more comfortable. And if you didn't back yourself, or if it went wrong, you'd still have a lot to fall back on.
I think as well, I'd maybe add that I would re-emphasize that I think you should look at it all as one big portfolio. And for example, if you feel like you want more, say you want more exposure to indexing, but you think, well, actually, that's what my pension's for. If you wanted to increase that allocation, I don't think there's any reason why you couldn't buy it inside an ISA. So I wouldn't be like too set on this is for this is for that. because if you want to change your allocations, then you can just do that.
Yeah. But what you might, for example, what you might not want to do would be, let's say if it was your pension and you were just, say, trying to, well, you could stock pick, but you might not want to sort of go and put potentially higher risk sort of individual picks if you are going to be reliant on that later in life for your income.
Yeah,
I don't know what you think about that, Sam.
Well, I agree. I've done it with my pension. It's just individual.
Yeah.
It's just in indexes, but yeah, I think you want to plan for the worst case scenario. And I think the worst case scenario really with investing is that you're not very good at it and you lose a lot of money. And I think with indexes, at least if the indexes go to hell, like everyone's absolutely screwed with you. So softens the blow anyway.
And not that we have any affiliation with Vanguard, but they do have some life strategy funds. And you can allocate, for example, 100% to equity, and it's globally diversified. I think they rebalance every so often to make sure you're not over allocate to certain parts of the world. But then they also offer, I think, 90% equity, 80% equity, 70% equity. And it basically goes down and they build up, I think, my understanding is a globalized sort of bond fund as well. So you've got sort of, if you wanted to diversify a bit and you didn't want to have as much exposure to equity, you could, sit with a slightly smaller percentage, whatever you're comfortable with, really. So that's certainly another option. But if you're in it for the long term and you're young, then you'd have thought that a larger exposure to equities might be better.
All right, I think we've covered quite a lot this week then, unless there's anything else you want to talk about.
I don't think so. I think we'll call it a day, and thanks for listening. See you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.